The classic starter home, the small, affordable house meant to get young buyers onto the property ladder, is vanishing from neighborhood after neighborhood. What used to be a modest two-bedroom you could buy with a steady job and a savings jar is now often snapped up by investors, priced well beyond entry-level incomes, or blocked by rules that make building new homes nearly impossible. This matters because it changes how people live. Couples move back in with parents, friends cram into tiny apartments, and dreams of owning a yard become a distant memory. First, we'll explain in plain terms the four forces behind this shift. Rising housing costs, zoning rules that limit new builds, investors treating houses like stocks, and tougher mortgage requirements. Using real-life examples you'll recognize. You'll also get 3 practical steps you can take right now to improve your chances of owning, plus one surprising option most people overlook. Stick around if you want clear answers, a few laughs, and real ways to fight back against a market stacked against first-time buyers. The vanishing entry-level inventory. Why builders stopped constructing small, affordable houses in favor of luxury high-margin estates. Builders are often choosing bigger houses because the math simply works better for them. When you add up the cost of buying land, installing roads and sewers, paying permit fees, and hiring crews, those expenses are mostly fixed no matter the size of the house. Building a larger, pricier home spreads those fixed costs across a bigger sale price, so the profit on each lot goes up. In plain terms, the same bill at the end of the month looks better when the paycheck is larger. A local builder might decide it makes more sense to put an extra bedroom and a fancy kitchen on a lot rather than squeeze 2 smaller, cheaper homes on the same plot. Municipal rules and fees push things the same direction. Many towns have minimum lot sizes, parking requirements, and costly impact fees meant to cover schools, roads, and parks. Those rules can eat up the margin on an inexpensive house, while a luxury home can absorb the costs and still return profit. Zoning that favors single-family plots also blocks builders from fitting more compact or attached housing types onto a parcel. You can see the result with neighborhoods where small bungalows are torn down and replaced with much larger houses. Neighbors call it replacement growth, and the street suddenly looks like it hit a size upgrade. Labor and materials are another practical reason small homes disappeared. Skilled crews are expensive, and there's a finite number of subcontractors in many markets. Builders prefer projects that minimize scheduling headaches and maximize return per crew hour. Rather than juggling many small projects that each require setup and inspections, a developer often chooses fewer, larger homes that keep crews busy and profit per project hire. The supply chain also nudges things upward. High-end finishes and bulk materials can be upsold in larger homes more easily, improving margins without dramatically increasing complexity. Market signals from buyers matter too. When investors and higher-income buyers are the loudest customers, builders follow the demand. If model homes with upgraded features sell quickly and at higher prices, the next phase in the subdivision will be more of the same. That feedback loop, higher-priced homes selling well leading to more higher-priced homes, shrinks the number of modest entry-level units. For a young couple or first-time buyer looking for something affordable, this translates to fewer options and more compromises. Finally, risk management plays a role that's easy to overlook. Building homes is a gamble. Land sits unsold, interest on loans piles up, and market taste can change. Selling one big house that clears costs and provides a buffer reduces exposure compared with selling several low-margin units, where one unsold home can hurt the whole project. So builders, like most businesses, often pick the path that reduces uncertainty. The result is a steady thinning of starter home stock and a lot of aspiring homeowners stuck bidding on the few affordable places left, sometimes competing with cash-rich buyers who treat houses as investments rather than homes. The Wall Street landlord. How private equity firms and hedge funds began outbidding families with all-cash offers. Institutional buyers, private equity firms, and hedge funds began showing up in ordinary home listings with an advantage most families simply can't match: cash. These organizations pool large amounts of money from investors and look for steady returns. Buying single-family homes with cash checks both boxes because it speeds up transactions and lowers short-term risk for sellers. Private equity is basically professional money managers buying things they think will make money, and hedge funds are similar, but often more flexible in strategy. Both can write a big check on the spot, which sounds boring until you realize how powerful that is at a suburban open house. All cash offers win because they remove uncertainty. A buyer who needs a mortgage brings a bank into the picture, along with appraisals, underwriting, and the occasional paperwork surprise. Cash buyers skip all that. Sellers like certainty, quick close, fewer contingencies, fewer chances for the deal to fall apart. That simple preference turns competitive bidding into a weird sort of auction where speed and surety beat emotional attachment or a heartfelt letter from the family who grew up next door. A young couple saving for a down payment can be outbid by someone who never needs to talk to a bank, and that's not about luck, it's about financial structure. Firms also operate at scale, and with tech tools single buyers don't have. They can scan neighborhoods with software that flags good investments, make multiple bids across towns in a single morning, and negotiate bulk deals behind the scenes. Real estate agents know these players. They often bring streamlined paperwork and the promise of a painless sale. Picture a teacher who brings a mortgage pre-approval letter and a single toddler in tow at an open house, then learns the house was taken by an investor who sent cash online before lunch. It's not dramatic in a movie way, but it is very effective. These investors sometimes convert homes into rentals, creating a cycle where houses that once would have been starter homes for families become income properties instead. The practical result is fewer available entry-level homes and more competition that doesn't look or feel like traditional buyers. When inventory tightens because institutional buyers scoop up homes quickly, prices can rise and negotiating power shift away from households trying to buy their first place. That ripple effect pushes some people toward renting longer or toward neighborhoods they had not planned on. Think of it like trying to buy the last slice of pizza while someone walks in with a stack of cash. You can beg, you can promise them you'll make a playlist, but the cash usually wins. The result is a real, everyday challenge for people who want to move from renting into homeownership, with humor only slightly softening the sting. The mortgage lock-in trap. How low interest rates of the past created a golden cage, preventing current homeowners from selling and freezing the market. Many homeowners today are sitting on mortgages with very low interest rates, and that reality is changing how people move and how houses change hands. Those low rates mean much lower monthly payments than the same loan would cost now. So selling a home often means taking on a bigger monthly bill for the next mortgage. That mismatch between what someone currently pays and what they've faced buying another house creates a strong financial incentive to stay put, even when family needs or job situations suggest moving would make more sense. Think of it as a golden cage. The home is perfectly livable, the mortgage payment is comfortable, and the price of freedom, stepping up to a larger or better located place, is suddenly steep. People who secured low rates years ago are reluctant to give them up because swapping to a new loan at today's rates can raise monthly costs by a lot. For many families, that difference is the single thing that determines whether they can afford a bigger home, avoid a long commute, or simply have one bathroom per person instead of 3 people sharing one. Practical examples make this obvious. A young couple in a modest 3-bedroom may desperately want a 4th bedroom for a baby on the way, but know that selling now would force them into a higher rate mortgage and much bigger payments. A retiree who locked in a low payment when leaving the workforce might prefer to downsize, but the math of losing that low rate versus the benefit of a smaller place often keeps them in the same house. Even if a family could qualify for a new loan, the upfront costs of buying, down payment, closing costs, moving expenses pile on top of the increased monthly payments and discourage action. The result is less inventory on the market. Fewer people willing to move equals fewer homes for first-time buyers and people looking to trade up. That scarcity creates fierce competition for the homes that are listed, pushing prices up and making it harder for newcomers to get a foothold. In neighborhoods where many owners enjoy low-rate loans, available starter homes can become especially rare, and what does appear often attracts multiple offers, making the whole process expensive and stressful for people trying to enter the market. There are a few workarounds, though none are magic. Some mortgages allow portability, meaning an owner can transfer their rate to a new property under certain conditions. Handy when it works, but not universally available. Renting out the current home while buying another can bridge the gap if rental income covers the old mortgage, but that comes with landlord headaches and added responsibilities. Homeowners can also shop for lenders offering creative products, seek seller concessions, or do a careful cash flow calculation to see if the move makes sense despite a higher rate. Crunching the numbers honestly helps avoid regret. This lock-in effect is, in short, a practical headache for mobility. It turns good mortgage deals into a kind of comfortable trap that freezes housing stock, raises prices for those trying to buy, and stretches the lifespan of so-called starter homes far beyond what builders and planners expected. A little humor helps too. It's like being offered a lifetime supply of your favorite snack. You're thrilled until you remember you can't trade it for vacation. Zoning and NIMBYism. How local regulations and not-in-my-backyard policies effectively criminalize the construction of affordable starter homes. Local zoning codes decide what kind of buildings can go up on a piece of land, and more often than not, they favor single-family houses over anything denser or cheaper. A lot of suburbs and even some city neighborhoods have rules that only allow one detached house per lot, require big yards, set minimum lot sizes, demand large setbacks from a street, and cap building heights. So the affordable compact row houses, duplexes, or small apartment buildings that first-time buyers could afford are simply not allowed. These technical-sounding limits aren't neutral. They shape what gets built and who can live where. In practice, that means neighborhoods that look charming also stay exclusive, not by choice of individual homeowners, but by the force of local regulations. Zoning restrictions add concrete costs to construction. Parking minimums, for example, force developers to build one or more off-street parking spaces per unit, which eats up land and money. When a builder is required to pave space for cars rather than split a lot into two small homes, the cheapest product they can offer becomes a larger, pricier house aimed at wealthier buyers. Rules that require long approval processes, special variances, or expensive infrastructure upgrades can turn a modest project into a financial headache. Developers often pass those added costs to buyers. So instead of a plain, sensible starter home, people get something that looks like a starter home only in name, and wallet shock follows. NIMBYism amplifies zoning spite. Homeowners show up to planning meetings and loudly object to anything that looks different. More people, different architecture, or a perceived threat to neighborhood parking or school capacity. Those objections are powerful because many local decisions are made in public hearings where a few organized opponents can outweigh the silent majority. Tactics range from arguing about traffic studies to dragging projects into lengthy legal fights or insisting on onerous design tweaks that inflate costs. A simple proposal for 2 small rental units can face weeks of campaigning, petitions, and appeals, turning a straightforward plan into a costly slog. It's like trying to sell cookies in a town where everyone insists the bakery should only make croissants. Cities and states sometimes try workarounds, allowing accessory dwelling units, or ADUs, so homeowners can add a small rental unit behind their house, or passing laws that reduce some local restrictions. These measures help in places, but they collide with local attitudes and additional rules. Owner occupancy requirements, tight size limits, parking and utility hookup fees, or outright neighborhood pushback. Homeowners who would like the extra income from an ADU often find the paperwork, inspections, and neighborhood resistance discouraging. It's as if someone opened a gate, but then sprinkled it with sticky tape. Real-life examples make this plain. A young couple might find a modest lot in a transit-rich area theoretically large enough for 2 small units. But the city's zoning only allows 1 house, and the Design Review Board demands that new construction match the existing, pricey aesthetic. A builder who planned 3 compact units ends up filing plans for a single large home because the alternative would require a variance and a long public fight. Meanwhile, neighbors stage meetings claiming property values and neighborhood character are at stake, when what they usually mean is their own investment. The result is fewer options for first-time buyers, longer commutes for people priced out, and a housing market that nudges toward bigger, more expensive homes. The combined effect of restrictive zoning plus vocal local opposition makes affordable starter homes rare even where demand exists. Supply is choked off in precisely the places where being close to jobs, transit, and schools would make small homes most practical. That mismatch pushes people farther from work, increases traffic, and widens the gap between those who can afford to buy and those who cannot. It's a local phenomenon with broad consequences, a neighborhood-level power play that adds up to a regional shortage of places a typical first-time buyer can actually afford. You could say the starter home got evicted by a committee, and that's not the sort of eviction anyone finds funny, even if the town meeting clapped politely afterwards. The build-to-rent revolution, the shift from selling the American dream to a corporate model of permanent, high-cost neighborhood rentals. Big developers and institutional landlords are increasingly building entire neighborhoods with the intention of renting every house, not selling a single lot. These build-to-rent communities are planned like subdivisions, but run like apartment complexes. Model homes, shared amenities, and a single corporate owner that treats dozens or hundreds of houses as one portfolio. Companies you hear about in the news are buying and building whole blocks of single-family homes, shifting the option from buying your first house to signing a lease for the same-looking property. The look and feel can be oddly familiar. New streets, manicured lawns, and playgrounds appear just like in a typical starter home neighborhood. But the lease agreement arrives with that picture. Residents may find standardized rules: what paint colors are allowed, how many plants you can have by the curb, and what happens if a tenant misses a rent payment. A young couple hoping to flip a starter house into a fixer-upper quickly discovers they can't because the house was never meant to be flipped. It was built to stay under corporate management. A family wanting to install a baby gate or hang heavy shelves learns they need written permission, not just a nod from neighbor. Part of the reason this model spreads is practical for investors and sometimes convenient for renters. Large landlords can buy lots of homes at once and hire centralized maintenance crews and call centers, which can mean faster repairs for small problems. On the flip side, those same investors aim for steady rental income. So rents often reflect market demand without the kind of price pressure that comes from people competing to buy. That means people saving for a down payment can watch similar houses disappear from the for-sale market or be listed only at prices out of reach because investors are turning them into rental units instead. Your monthly rent helps someone else build equity, not you. There are also cultural effects that don't show up on the sales contract. Ownership traditionally encouraged local involvement. Neighbors volunteering for school boards, investing sweat equity into a porch, or lobbying to fix a pothole. When a corporate owner is several phone calls away, decisions about tree trimming or community event can be delayed or made purely on cost calculations. This can dull the sense of neighborhood rootedness. At the same time, some renters appreciate not having to handle major repairs or unexpected renovation bills, but they trade that responsibility for less control over their living space. If owning a starter home feels impossible in your area, because of this shift, there are practical routes to consider. Look into community land trusts and local first-time buyer programs that prioritize for sale units. Explore neighborhoods with small, local builders rather than large institutions, or consider shared equity models where buyers get help with down payments in exchange for a portion of future gains. And when dealing with build-to-rent communities, read leases carefully. Ask about rent increases, maintenance response times, and any move-out charges. It's not a romantic solution, but being savvy about the rules can keep your living situation from feeling like you're temporarily camping on someone else's investment. The hidden costs of modern living. How skyrocketing insurance, property taxes, and HOA fees make even affordable homes financially toxic. Homeownership now carries layers of ongoing bills that can quietly push a modest monthly budget into the danger zone. Insurance companies are charging more because the cost to rebuild after storms or fires has climbed, and some insurers are pulling out of high-risk areas entirely. That means a homeowner who thought they were protected finds their policy non-renewed, must shop for coverage in a smaller market, or is routed to a state-backed insurer with higher premiums and stricter terms. Often wind and flood damage are carved out of standard policy, so buyers in coastal or riverine neighborhoods discover they need separate coverage for the exposures they actually face. Property tax bills are another shock for first-time buyers who budget only for principal, interest, and utilities. Local tax bills are based on assessed value, and when your home is reassessed or the local government raises rates to cover things like schools, roads, or pension shortfalls, the tab goes up. Many communities have rules that trigger reassessments at sale, and a single hot market can mean a large increase on that next bill. Folks who set up escrow accounts with their lender can still be surprised at the annual adjustment letter showing a much larger payment than expected. The result is a comfortable mortgage payment on paper, but a tight month when taxes are due. Homeowners Association fees add a third, often underestimated, layer. HOAs cover common area maintenance, landscaping, security, and sometimes utilities, but they also fund reserve account for major repairs. If the reserve study is outdated or the community faces an unexpected failure, a collapsed roof on the clubhouse, a leaky underground pipe, or a failed elevator, boards can levy special assessments. That means a low monthly fee can turn into a big one-time charge. First, know a condo owner who bought into a community because the monthly dues were friendly, only to get hit with a surprise assessment for roof replacement that wiped out months of savings. It's a classic bait-and-switch without malice. Maintenance was deferred until it couldn't be ignored. Taken together, these costs can make an affordable home financially toxic. The mortgage might be manageable, but when insurance premiums climb, tax bills reset, and HOA fees spike or trigger emergency assessments, monthly cash flow suffers. Lenders and mortgage calculators sometimes include estimates for taxes and insurance, but those are snapshots, not guarantees for the next 5 years. Practical checks help. Get insurance quotes for your exact address before signing. Ask the HOA for recent budgets and reserve studies, and request several years of property tax history from the seller or the county assessor. Build a cushion into your budget. It's not glamorous to plan for a new roof or a hurricane deductible, but it's a lot less stressful than getting a letter saying the insurance canceled or the association needs a big check. A little homework up front saves a lot of late-night ramen dinners later. The downward mobility spiral. How the inability to build equity through housing is widening the wealth gap and destroying the middle class. Homeownership has long been the main route for middle-class families to turn monthly shelter costs into lasting wealth, because mortgage payments gradually swap rent like spending for actual ownership. When people buy a house and pay down the loan, they build equity. That is, the portion of the home they truly own, which can be tapped for emergencies, education, or a down payment on the next, larger home. Now, though, that pathway is fraying for many households, and losing it has knock-on effects that extend well beyond just where people live. Wages for typical workers have been mostly stuck while housing prices in many areas climbed faster, so the gap between what people earn and what they need to buy a home is widened. Add student loans and other debts into the mix, and the upfront costs of buying, down payments, inspections, closing fees look less like a hurdle and more like a wall. A common real-life scene. A nurse or teacher saving diligently for years, only to be outbid by an investor willing to pay cash. The nurse keeps renting, and someone else starts collecting the forced savings that would have been hers. It sounds unfair because it is. Rental markets also feed the spiral. As investors buy up smaller, affordable homes and convert them to rentals, competition for the remaining entry-level houses tightens and rents rise. Renters pay month after month with nothing to show for it except a place to sleep. Owners, by contrast, are building an asset that often rises in value or at least cushions them against future shocks. Picture a young couple who finally scraped together a down payment. They buy a modest house, fix it up, and gain a little equity. Now imagine that the next wave of buyers are institutional investors snapping up similar homes within blocks, turning small neighborhoods into portfolios rather than communities. The couple's potential neighborhood appreciation is now being driven by investors instead of local wage growth, and that equity-building engine stalls. The erosion of housing-based equity also reshapes financial safety nets. For middle-class families, the house often serves as emergency credit, a line to pay for a big medical bill, for post-secondary education, or to bridge a layoff. Without that option, families turn to high-interest loans, credit cards, or simply go without, and financial instability becomes more frequent. A retired couple who had planned to downsize and use the proceeds to cover healthcare costs may instead find the market cold and their house's value stagnant. That plan falls apart quietly but powerfully, and the stress shows up in other parts of life. Less spending on goods and services, more reliance on public assistance, or delayed retirement. Local rules and market structures intensify the problem. Zoning that limits housing density keeps supply artificially low in desirable areas, which drives prices up. Lenders who demand large down payments or tighten borrowing rules make it harder to enter the market in the first place. Meanwhile, maintenance costs and property taxes can eat away at the thin equity new homeowners have. A leaky roof or a surprise tax reassessment can undo years of saving. In practice, this means that even those who manage to buy often remain house poor, owning an asset but with little liquid wealth, while those who are shut out of buying miss the main vehicle many families use to move up economically. The cumulative effect is a widening wealth gap and a hollowing out of middle-class stability. When a significant share of asset appreciation happens in housing and only a subset of households can access it, wealth concentrates. That's not just an abstract economic point. It's the reason a teacher, a firefighter, and a small business owner can work comparable hours and still diverge dramatically in net worth over time. Policy responses like expanding affordable housing supply, easing down payment hurdles responsibly, and protecting small-scale owner-occupiers from being priced out can help, but the human side remains. Without the ability to build equity through owning a home, many families lose what used to be the most reliable ladder into lasting middle-class security. The ladder is still there in some places, but the rungs are getting farther apart. The future of shelter, exploring radical alternatives, from tiny home communities to the reality of multi-generational, forever renting. High housing costs are pushing people to try living arrangements that would have sounded strange a generation ago. Tiny home clusters, small houses usually between 100 and 400 square feet, are one route. They often sit in villages where people share a big kitchen, laundry, and a garden. Some tiny homes are on wheels and treated like recreational vehicles by regulators, which makes them hard to finance with a regular mortgage. Owners may pay cash, take an RV loan, or use creative financing from local nonprofits. A friend of mine lives in a 250-square-foot place with a fold-down table, a loft bed, and a community shed full of tools. She jokes that the daily challenge is finding a shirt that isn't next to the toaster. Living small forces serious choices, less private space, but also lower bills and fewer things to clean. Multi-generational renting is becoming less of a temporary fix and more of a long-term lifestyle for many families. Adult children renting rooms with parents, grandparents staying near caregivers, or 3 generations sharing a duplex can cut housing costs, pool childcare, and swap cooking duties. Renting instead of owning means no equity building, true, but it also means flexibility. If a job moves you or health needs change, you can go without selling a house. Legal protections like long-term leases and tenant-friendly laws can add stability. Yet those protections vary by place, so it's smart to read the lease. Think of it as a roommate situation expanded by family obligations and love, and sometimes by clashing dinner preferences. Shared living models extend beyond family households. Co-housing brings private living spaces together with common rooms, gardens, and shared meals. People deliberately design rules about chores and noise. Community land trusts separate ownership of land from ownership of the home built on it, making housing cheaper because people lease the land long-term while owning or leasing the dwelling. Accessory dwelling units, small apartments added to an existing property, like a converted garage or basement flat. Let homeowners create housing for relatives or renters on the same lot. Each model slices the cost of shelter in different ways. Shared services cut bills, land trusts lower purchase costs, and ADUs increase supply, without changing neighborhood feel too dramatically. There are trade-offs, naturally. Shared arrangements can provide strong social networks and lower environmental footprints, since residents share appliances and cars. Yet privacy can be scarce, and regulatory rules or mortgage rules can block unconventional builds. Practical steps help a lot. Check local zoning and insurance early. Draft clear household agreements about chores and guests, and explore nonprofits or municipal programs that support alternative housing finance. A dose of good humor goes far. 2. Bring earplug for the inevitable community movie nights. These alternatives aren't one-size-fits-all, but for many people, they offer a workable way to secure shelter when traditional home ownership is out of reach. To wrap up, the starter home is fading because prices have jumped faster than paychecks. Builders make fewer small, affordable homes. Investors scoop up single-family houses, and higher mortgage costs plus big down payments push first-time buyers out. Add local rules and rising construction costs, and it's easy to see why a modest house that used to be within reach now feels like a luxury. Think of the house your parents bought for a song. Today, that same place could be sold at auction to the highest bidder. First, know this: it's home for a lot of you. Maybe you've been saving for years only to get outbid, or you're choosing between rent and a longer commute. That frustration is real. First, VE heard stories from friends who finally gave up and bought a tiny fixer-upper, and others who started house hacking with roommates just to break even. Life example: a small bungalow that used to cost a year's salary now costs 3. That's a lot of overtime. If this video made you think, share your story in the comments. First, want to hear what's happening where you live. Like and subscribe if you want practical tips, and hit the bell so you don't miss what's next. We'll dig into real solutions, from community land trusts and co-ops to smart saving strategies, policy fixes, and interviews with people trying to change the system. Let's figure this out together. Unless you're intentionally buying a van and calling it minimalist living.